Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Joining us back today is the head of research of Gold Money, Alasdair Macleod. Thanks for joining us back, sir.
That's my pleasure, Ivan.
Always. Alasdair, the world's economy is an absolute mess, and with inflation surging and unprecedented debt, gold and silver should be surging. Why has precious metals stayed the same levels?
Or falling.
Or falling.
Or falling, yes. I think, the easy answer to that is that the investment community's attention has moved from inflation to recession. So now suddenly nobody's thinking about what's happening to prices, or perhaps they're thinking that what will happen to prices is that they will normalize because we face a massive recession. So inflation to these guys is not such a problem. The real problem is recession. And so you can see that from that point of view, everybody's just getting out of everything which has got risk. And, if you're a Keynesian, that includes gold and silver. I mean, the only place where you don't have risk, apparently, is in US Treasuries. And so you can see that not only US Treasuries, but government bonds around the world, their yields have dropped in the last 2 to 3 weeks, fairly significantly. And I think that, if you like, is the short answer to it. There is another answer, and I think a more technical one, and that is that the bullion banks want to try and get their books straight. Now, on COMEX, they're long of silver. I don't know, and nobody knows what their position is in London. Bear in mind that these banks all run unallocated accounts for their customers. So they are effectively short to those customers unless they are fully covered with physical silver, which of course they're not. And the same is true of gold. I mean, in terms of gold, certainly in London, there is a huge short position on the derivatives. The risk to it is probably theoretically limited, because what bullion banks do is they will take out options, if you like, to limit the downside from their point of view of rising prices. But who are their counterparties? Their counterparties are other people in exactly the same problem. So you've got a derivatives-driven market. Obviously, these bullion banks want to get their positions down. And the only way they can do that is by playing on the fear, if you like, that we have a recession, inflation has gone, so sell your gold. And that's really what we're getting. And it works very well as far as they're concerned with the hedge funds, because the hedge funds just do a pairs trade. I mean, they buy gold, sell dollar, buy gold. And you can see that the gold's trade weighted has absolutely soared in recent weeks. So from a hedge fund's point of view, they will short gold and go long the dollar. And so that, I think, is really the sum total of the dynamics driving it at the moment. It is not anything to do with sensible, logical, thought out economics. It's purely technical in that sense.
Are we making a mistake to, a lot of people seem to think that we're, trying to make this comparison to 2008 and trying to find out what stage of 2008 are we in, the financial crisis. Are we, what's the trigger that's going to make gold go up 100% or something?
It's an interesting comparison, Jim, because I'm sure you will recall that the initial response of the market was to mark gold and silver down very sharply when Lehman failed. And we then recovered from, I think it was $680, something like that, and ran up to 1920, with really quite quickly. So it is interesting to me because really what that indicated was that the first reaction was essentially a Keynesian reaction, and it was not the correct reaction in terms of valuing, if you like, gold and silver in the sense of financial assets. So, and we saw this. We saw this again because you will remember that in March 2020, the stock market collapsed. bond yields, if you like, bonds became, if you like, the safe haven for people trying to get the hell out of equities. I mean, the equity market fell fully 1/3. I mean, we forget this now. And that forced the Fed to reduce the funds rate down to zero and to bring in QE of 120 billion a month. Mm-hmm. And that turned the market round. And what had happened to gold and silver was it really caught the bullion banks on the hop. And you remember that the exchange for physical market blew up. And we saw ridiculous stories coming out of the LBMA and the CME about how, gold was just in the wrong place, but they were going to fly it over and it was going to be all right. And they sort of worked together to try and stop the market rising, which is effectively what it is. And to my mind, that is exactly what we've got now. We've got that situation developing yet again, because we can see that the bullion banks are driving the prices down. They're taking advantage of the current situation, the so-called strength of the dollar, which is not strength at all. I mean, off camera, we were talking about the dollar and how it is, the least weak of a bunch of weak fiat currencies. But make no mistake, the inflation problem is there. And it's going to continue because of all the money printing that's happened, particularly over the last 2 years, and more generally well before that. So, and we know that the response of the Fed will be to always make sure that there is sufficient money available for people to spend. And that basically means that they're going to debase the currency even more. And that means that gold and silver, measured in debasing currencies, will rise in price.
Well, that's the big question mark is, when will the Fed stop raising rates and go back to easy money? And a lot of people are saying, well, they have to kill inflation first. A lot of people are saying, well, they can't take the pain of what if inflation stays high, but the pain of the economy slowing down just grows to be too much for them to handle, and the political pressure forces them to go back to easy money, 0% QE, even while inflation's. Where do you fall in that camp? Do they have to fight inflation no matter what, Paul Volcker style, or are they going back to easy money because they can't handle the pain?
Long before we get into Paul Volcker territory, the markets will collapse. I can tell you that for nothing. And the currencies will go with it because, we've seen the effect of a relatively small rise in the Fed funds rate, which is what now, 1.5%. And we've seen the US Treasury 10-year yield. It soared very briefly to 3.5%, but basically, anything over 3%, this is Doomsville. I mean, it really is absolute disaster. So you can see that it's not going to take very much to destabilize the whole thing. And the other thing you need to look at is the banking system elsewhere. The American banking system is, so far as I can see, one of the more healthy banking systems in the world. You go into the Eurozone and you look at the relationship between the assets, a bank's assets, and its equity. And you find that we're looking at relationships of well over 20 times. And if you take into account the capitalization of the equity shares, we're looking at 60, 70 times. I mean, this leverage, wow. It takes a small earth tremor, basically, to destabilize the whole thing. Mm-hmm. This is also true in Japan. And this is one of the reasons why the Bank of Japan is insisting that it's not going to let the yield on the 10-year JGB exceed 0.25%. No big figure, just 0.25%, 0.25%, yeah. 25 basis points, anything more than that, and it's disaster. And it's disaster partly because of all the bonds on the Bank of Japan's balance sheet. I mean, they are already in negative equity.
Well, yeah, the Bank of Japan owns 51% of the Japanese bond market now. Yeah, if they let rates rise in Japan, then they're sitting on an unrealized, all the losses just pile up. I saw one statistic that our own Fed, who has a $9 trillion balance sheet. Just the rates that have risen in the past few months, our own Fed is sitting on $500 billion in losses on their bond portfolio.
Yeah.
Because they bought all these bonds, these mortgage bonds and government bonds at ridiculously low rates. So they have much lower value now at the current rates. I mean,
Yeah.
it's not a realized loss. Of course, they're going to probably hold them till maturity. It just becomes a question of, when does this end? When does the pain end? We're in this gold and silver trade, and the mining stocks, a lot of people just thinking, all right, gold and silver are going to have their moment. And a lot of people are just getting very frustrated. I'm hearing it. I'm seeing it on Twitter. I'm seeing it on Reddit. And a lot of people who I used to see as really, the strong gold investors, they're like crying, they're whining, they're getting very negative, they're getting very despondent. And I don't know, maybe this is the capitulation you need before the rise or our moment of the gold and silver stocks taking off. I don't know.
Yeah, no, Jim, I think that is fair comment. This is, if you like, that capitulation moment. Of that, I have no doubt. Mm-hmm. But what you have to ask yourself is that with the whole financial system falling apart, and I think we can agree on that, how do you protect yourself? And the answer basically is to get out of the system. How do you get out of the system? Well, there's only one way out of the system, and that is to put as much of your resources as possible into real money. Now, the legal definition of real money is gold or silver. And it is particularly gold because no central bank has silver anymore, so far as I'm aware. I mean, that basically fell by the wayside in the sort of 1870s, roundabout then. And in America, I think in about 1900, when it was then formally replaced with the gold standard. So, the answer to this is that if you want to protect yourself from everything that's collapsing, then price is immaterial. You just got to get the hell out of it. And where do you go? Well, there's only one way to go, and that's real money. And I don't mean representatives of real money, such as derivatives or mining stocks or whatever. But real money is physical gold and nothing else. And that is a legal definition, by the way. It is not an emotional definition. And this does not include cryptocurrencies. Cryptocurrencies are not real money. Mm-hmm. So, whether they go up or down, I couldn't give a damn. I really don't. But all I'm interested in is the legal position and how it is that people in the crypto community think that this is ever going to become money. I mean, they have yet to properly explain it beyond an emotional desire for it to be money. It's not money. Legally, it is not money. And it hasn't been since Roman times. Okay, it wasn't invented in Roman times, but gold has always been legally money. And it goes back to the Justinian in that was the 6th century AD. And everybody has adopted that, including the American monetary system. I mean, the fact that they ban you from time to time from holding physical gold does not change its legal status. It is still the only form of money. Everything else is credit. Everything else is credit.
Well, that lately there's been this new movement by Vladimir Putin. And hold on, let me get Vlad back there in the vault here. He's joined up with Brazil, India, China, South Africa to form this BRICS commodity-backed, let's call it a commodity-backed reserve currency. And I'm sure you're all up to date on that. How would that actually function in a real-world scenario if they wanted to settle trade? Are they going to create a new currency backed by a basket of commodities? I mean, how does that work in practice? Have you thought about that at all?
Oh, absolutely. I mean, I've written about it. But incidentally, in your list of BRICS members, you've missed one new applicant, and that is Saudi Arabia.
Yeah, I saw that.
They are joining. They're looking to join. In fact, I was aware that the Middle East was looking very much towards China in terms of gold a long time ago. I interviewed a director of a Swiss refinery, one of the major refiners, and he told me that Arab interests were sending him gold to be re-refined from 400-ounce LBMA standard into the new Chinese 1 kilo 4/9 standard, and taking it back into storage. So, now that to me was quite clearly, people thinking ahead and thinking, where is our long-term future? It's not going to be in Europe. It's not going to be in America. It's actually going to be with the emerging Asian superpowers. I mean, we're talking 2014. This is some time ago. Wow. And that is really what's happening now. As to this new intended currency, it's intended to be a trade settlement currency. Now, I wrote an article about this, and I ran some numbers through, taking, I think it was a total, I could find about 19 different commodities, metals, energy, and also farming commodities, but non-cyclical. I'm not talking about, the sort of the grains, which sort of go up and down with the season. And if you take those 19 and you rebase it in gold, you find, going back from 1968, I think was the earliest I could do this. The price of this basket actually is about the same as it was in 1968. So, and not only that, but the volatility in gold was considerably less. So in a sense, if they have this new trade currency as just a trade settlement currency, it is almost the equivalent of having a gold standard. Now, obviously, it doesn't work as a gold standard because this new trade currency would be fixed against the participating national currencies on a daily basis. And, that is what you would take as an importer or exporter. And you would use that as opposed to having dollars, let's say, sitting in Citibank or Bank of America or whatever. So this is definitely something that will work. But I see it as a bit of a stopgap because this can't work as a national currency. So, part of me sort of takes the thing seriously in the sense that it is doable if you know what you're doing. But the other half of me sort of thinks these guys just are completely clueless. They've got no idea at all. Actually, what they should do is they should mobilize their gold reserves and just go on a gold standard. I mean, that is actually the simplest answer because we know what it is and everybody knows what it is. And okay, we Americans and we Europeans have forgotten, if you like, that gold is money because we've had the propaganda for God knows how long. But I can tell you that in Asia, gold is money, and they still understand that. So
for there to be a gold standard, doesn't someone have to have a gold window? Be willing to exchange a currency for gold? I mean, like the U.S. Treasury used to have the gold window. Regular guys like you and me, we couldn't go up and exchange dollars for gold, but other governments could do that. At some point, someone has to their currency and make it exchangeable for gold, correct?
Yeah, Jim, that was Bretton Woods. But before then, in this country, we had a gold coin standard, which meant that one sovereign, you could change that or get a pound note, if you like, from the Bank of England. You could cash that in for a gold sovereign. £1 was one sovereign. And now we find that, do you know what the price of a sovereign is? £370. So from just before the First World War, that's what's happened to paper currency. And the only way in which you will really get a gold standard to work long term is to have a gold coin exchange standard. And that's where we should be aiming. I mean, I wouldn't hold out too much hope that we'll actually get there, but because we're looking through a systemic crisis of the banks all failing and having to be rescued. We're looking through a currency crisis. We're looking at what governments will try and do to prices. I mean, look at Joe Biden with energy prices, telling the gas providers, look, you've got to, you've got to keep the prices down. Oh, come on, man.
Come on, man.
It's just ridiculous. But I mean, to be fair to Joe Biden, every politician from Diocletian onwards has basically followed that line. And it's always wrong. It's always wrong.
Wow.
Well, thank you very much for joining us. We really appreciate you join from London, and the time changes, getting us all on Zoom together. It's a bit of a challenge, but we appreciate you making the time for us. Our audience enjoys hearing from you, and we'll do it again in a few months.
That would be very much my pleasure, Jim.